TILA/RESPA Integrated Disclosure Rule, TRID. When you reach this point in your study of closings, you have already seen how escrow works, how the closing disclosure summarizes the financial settlement, and how RESPA protects consumers from hidden or excessive settlement charges. The TILA/RESPA Integrated Disclosure Rule, often called TRID, brings those ideas together into one practical question. Exactly what must the lender tell the consumer? When must it be delivered? And how accurate does it have to be? TRID combines parts of two federal laws. The Truth in Lending Act, TILA, focuses on the cost of credit, while the Real Estate Settlement Procedures Act, RESPA, focuses on settlement costs and abusive practices like kickbacks. Before TRID, consumers got separate and sometimes confusing forms, such as the Old Good Faith Estimate, GFE, Early TILA Disclosure, and HUD-1 Settlement Statement. Since 2015, TRID has replaced those forms in most closed-end consumer mortgage loans with two integrated forms: the Loan Estimate, LE, and the Closing Disclosure, CD. As a real estate licensee, you are not responsible for preparing these forms, but you must understand what they mean, when they must be given, and how they affect the timing of closing, so you can guide your buyers and sellers through the process. TRID's goals are simple. Give borrowers clear, early, and accurate information about the cost and terms of their loans. Give them time to compare loans and ask questions, and prevent last-minute surprises at the closing table. In practice, that means strict rules about delivery timelines, what counts as a completed application, how much certain charges are allowed to change, and when the lender must redisclose and possibly delay closing. Forms and procedures under TRID applies to most closed-end consumer mortgage loans secured by real property, such as typical home purchase loans or refinances of a primary residence, second home, or investment property. It does not apply to home equity lines of credit, reverse mortgages, or loans secured only by a mobile home when it is not attached to land. For covered transactions, the lender must use two key forms: the Loan Estimate, H24, and the Closing Disclosure, H25. An application is considered received for TRID purposes when the lender has 6 basic pieces of information from the borrower: name, income, social security number to obtain a credit report, property address, estimated value of the property, and the loan amount sought. Once these 6 elements are in hand, the clock starts. Within 3 business days of receiving this application, the lender must deliver or mail 2 things: the CFPB booklet, Your Home Loan Toolkit, which explains the mortgage process in plain language, and the Loan Estimate, which outlines the key terms and settlement costs the borrower is likely to pay. For this 3-day period, a business day is defined as any day. The lender's offices are open to the public for substantially all of their business functions. Later in the process, at least 3 specific business days before consummation of the loan, the lender must provide the closing disclosure. For this 3-day review period, business day is defined more strictly as any calendar day except Sunday and legal public holidays. Consummation means the day the borrower becomes legally obligated on the loan, which is usually, but not always, the same calendar day as the real estate closing or recording date, depending on state law and custom. As a practical matter, this means buyers cannot receive a CD for the first time at the closing table. They must have the completed CD in their hands at least 3 business days before they sign the loan documents. If certain major terms change, for example, the APR increases beyond a tolerance limit, a prepayment penalty is added, or the loan product changes from a fixed rate to an adjustable rate, then a new CD and a new 3-day waiting period may be required. That is why agents and escrow officers must be careful with late changes to the contract or closing figures. Even well-intended last-minute adjustments can trigger delays if they affect the loan terms. Good faith and tolerance rules. TRID does more than set timelines. It also requires that the figures shown on the loan estimate be made in good faith. Good faith is measured by comparing the charges originally disclosed to the actual charges that appear on the closing disclosure. Some categories of fees have zero tolerance for increases. Some have a 10% cumulative tolerance, and some can change without a specific cap as long as they were estimated based on the best information reasonably available at the time. Zero tolerance charges typically include lender fees under the lender's control, such as origination charges, and fees for third-party services that the borrower cannot shop for when the provider is selected by the lender, such as an appraisal or credit report ordered through the lender's approved vendor. If these amounts increase above what was disclosed on the loan estimate and the increase is not justified by a valid change circumstance, the lender must cure the violation by refunding the excess to the consumer within 60 calendar days after consummation. The 10% cumulative tolerance category includes certain third-party services and recording fees. When the borrower is allowed to shop but chooses a provider from the lender's written list, or when the lender requires particular categories of services. In this category, individual items may vary, but the total of all such fees cannot exceed the total disclosed on the loan estimate by more than 10%. If they do, the lender again must refund the difference within 60 days. Other charges fall into the no tolerance limit category, such as prepaid interest, property insurance premiums, and amounts placed into escrow or impound accounts, and charges paid to third-party providers chosen solely by the consumer who are not on the lender's written list. These may increase or decrease, but only if the lender's original estimate was based on the best information reasonably available at the time of disclosure. The key principle is that lenders must act honestly and diligently when preparing the loan estimate and may not play games with lowball estimates just to win the borrower's business. From the old good faith estimate to the loan estimate, before TRID, the main RESPA disclosure was the good faith estimate, GFE, which tried to itemize settlement fees in a standardized format. While the GFE taught important concepts such as comparison shopping, rate locks, and itemized closing costs, borrowers and industry professionals alike found that multiple overlapping forms, GFE, early TILA, and HUD1, often created more confusion than clarity. TRID keeps many of the same consumer protection ideas, but delivers them through the loan estimate and closing disclosure instead. Today, when a borrower like Peyton applies for a loan, the lender still examines her income, debts, creditworthiness, property value, and loan amount she is seeking. The lender still must provide early disclosure of the interest rate, whether that rate is locked, whether the loan has a balloon payment or prepayment penalty, how much the monthly principal and interest will be, and a breakdown of closing costs and prepaid items such as taxes and homeowners insurance. The difference is that this information now appears on the standardized 3-page loan estimate, not a GFE. The loan estimate is designed to make side-by-side shopping simpler. Borrowers can compare interest rate, APR, total closing costs, total cash to close, projected monthly payments, and whether taxes and insurance are included in escrow for multiple loan offers. As an agent, you do not explain every line of the loan estimate in the way a loan officer does, but you should be able to help a buyer understand big-picture questions, such as whether the PITI payment fits the buyer's budget, whether a prepayment penalty is acceptable, and whether the estimated cash to close is realistic based on the buyer's available funds. The H-25 Closing Disclosure Form, page by page. The closing disclosure is the companion to the loan estimate. Where the LE is about estimates at the beginning of the process, the CD is about actual numbers at the end. It is a 5-page form that mirrors the structure and language of the loan estimate, so borrowers can see how their deal evolved from application to closing. Page 1 contains 4 major sections: general information, loan terms, projected payments, and costs at closing. In the general information area, the borrower sees the property address, sale price, closing and disbursement dates, file number, settlement agent, as well as the names and addresses of the borrower, seller, and lender. The loan information block lists the loan term, purpose, product type, for example, fixed rate or adjustable rate, loan type, such as conventional, FHA, or VA, and the loan ID number. This orients everyone to which transaction and which loan this disclosure describes. The loan terms section states the loan amount, interest rate, and monthly principal and interest payment, and clearly indicates whether any of those figures can increase after closing. It also discloses whether there is a prepayment penalty or balloon payment, two features that can significantly affect a borrower's risks and long-term costs. The projected payments section shows how the total monthly payment is expected to look over time, including principal and interest, any mortgage insurance, and estimated escrow amounts for property taxes and homeowners insurance. For example, an FHA borrower might see a higher payment in the early years because of mortgage insurance, and then a lower payment once that insurance drops off. The costs at closing section summarizes the borrower's total closing costs and the total cash to close. These amounts are expanded on later pages, but page 1 gives the borrower a quick snapshot. Here's how much you need to bring in certified funds, wire transfer, or other acceptable form. And here is roughly how that total breaks down between loan costs, other closing costs, and credits. As an agent, this is often the first place you and your buyer will look to confirm that the numbers align with what you expected based on the contract, any seller concessions, and prior lender quotes. Exhibit 21.11, Sample H25, Closing Disclosure, page 1. Page 2 looks very similar to the old HUD1 in structure. It is divided into loan costs and other costs, and for each line, it shows who is paying the cost and whether it is paid before or at closing. Loan costs include origination charges, points, application fees, underwriting fees, services the borrower did not shop for, such as appraisals, credit reports, and some lender-required title services, and services the borrower did shop for, such as pest inspections, survey, or owner's title insurance. Other costs include taxes and recording fees, prepaid items like homeowner's insurance, and prepaid interest, initial escrow deposits for taxes and insurance, and miscellaneous items such as HOA transfer fees, home warranties, and real estate commissions if they are disclosed on the CD. Seeing all of this on one page helps the borrower understand where every dollar is going and which charges are lender-related, government-related, or third-party services. Exhibit 21.12, Sample H25, Closing Disclosure, page 2. Page 3 is where everything comes together. The top section, Calculating Cash to Close, compares the figures from the loan estimate to the final numbers on the closing disclosure. It shows whether total closing costs have increased, whether the deposit or earnest money matches what is in the contract, and whether seller credits or other adjustments have changed. If a category of fees exceeds legal tolerance limits, this is where the lender must show that and provide any required lender credit. The bottom of page 3 contains two summary columns, one for the borrower's transaction and one for the seller's. The borrower's column lists amounts due from the borrower, such as sale price, closing costs, and certain prorations, and amounts already paid, such as earnest money and loan proceeds. Then calculates the final cash the borrower must bring. The seller's column lists amounts due to the seller, sale price and adjustments, and amounts the seller owes, payoff of existing loans, seller paid closing costs, and seller credits. Then shows the net cash the seller will receive. Exhibit 21.13, Sample H25, Closing Disclosure, page 3. Page 4 focuses on other important loan terms that do not fit neatly into the cost tables. It discloses whether the loan can be assumed by a future buyer, whether there is any demand feature allowing the lender to call the loan due early, The late payment policy and fee. Whether the loan allows or involves negative amortization, and how partial payments will be handled. It also describes the security interest in the property and gives details about the escrow account, which items are being escrowed, how much the monthly escrow payment will be, and whether any items like taxes or insurance are not escrowed. These disclosures matter when a borrower later wants to refinance, sell, or get for future payments. Exhibit 21.14, Sample H, 25, Closing Disclosure, page 4. Page 5 contains high-level loan calculations and other disclosures. The loan calculations show the total of payments over the life of the loan. The finance charge, total cost of credit in dollars. The amount financed, essentially the loan amount minus certain prepaid finance charges. The annual percentage rate, APR, and the total interest percentage, the total interest paid as a percentage of the loan amount. These concepts go beyond the simple note rate and help borrowers compare the true cost of different loan offers. Other disclosures on this page include information about the appraisal, what happens after foreclosure, whether the loan can be refinanced, and tax deductibility cautions. At the bottom, the form lists contact information for the lender, mortgage broker, if any, real estate agents, and settlement agent. Signature lines may appear with language clarifying that signing only acknowledges receipt of the form, not acceptance of the loan itself. Exhibit 21.15, Sample H25, Closing Disclosure, page 5, Closing Disclosure, explained https rru2.b/qbzm0nuwq review. Summary: how TRID shapes the closing experience taken together. The TRID rules create a predictable roadmap from loan application to closing. The borrower receives early standardized information on the loan estimate within 3 business days of application. The lender must act in good faith and stay within tolerance limits for most fees, or cure any overages shortly after closing. Before the borrower becomes legally obligated on the loan, the lender must deliver a final closing disclosure that mirrors the structure of the loan estimate and clearly shows any changes. The borrower then has at least 3 business days to review that disclosure, ask questions, and, if desired, compare it to other loan options. For you as a real estate professional, TRID affects the pacing and coordination of the transaction. You must plan for the 3-day CD review period. Avoid last-minute contract changes that could alter loan terms, and communicate clearly with the lender and settlement agent about credits, prorations, and fees that will appear on the CD. You should also be prepared to help your clients understand the broad strokes of the loan estimate and closing disclosure, what their monthly payment will be, how much cash they need to close, whether there are any features like prepayment penalties, and whether the closing costs generally align with what they expected. When everyone understands the forms and respect the timelines, the closing becomes less stressful and more transparent for both buyers and sellers. Discussion. A. Buyer calls you in a panic the day after receiving the closing disclosure, worried that they are locked in and must accept the loan because they signed the form to acknowledge receipt. How would you explain the purpose of the signature and their rights during the 3-day review period? Suggested answer. You could calmly explain that signing the closing disclosure only confirms that they received the form, not that they must accept the loan. The 3-day review period is designed to give them time to study the terms, ask questions, and even compare with other lenders if they wish. If they see something they do not understand or agree with, they should contact their loan officer immediately. You, as their agent, can also help them compare the CD to the original loan estimate and the purchase contract so they feel comfortable before moving forward. A seller is upset because the closing date must move by 3 days after the lender issues a revised closing disclosure due to a change in APR. How can you help the seller understand why this delay is required and why cooperating is still in their best interest? Suggested answer. You could explain that federal law requires lenders to give borrowers a full 3 business days to review certain significant changes to the loan terms, such as a meaningful change in APR or the introduction of a prepayment penalty. The delay is not optional. It is designed to protect the borrower from surprises. While inconvenient, cooperating with the new date keeps the transaction on track and avoids legal problems or last-minute cancellations. You can also help the seller see the big picture. A short delay is usually preferable to losing the buyer altogether and starting over. A buyer notices that some closing costs on the CD are higher than on the original loan estimate and asks if the lender is allowed to do that. How would you walk them through the idea of zero tolerance, 10% tolerance, and no limit categories without turning it into a law school lecture? Suggested answer. You might say that some fees, especially lender fees, and certain required third-party fees, are not supposed to go up at all unless there is a valid change circumstance. Others, like some recording fees and certain third-party services, can go up a little as long as the total of those items does not increase by more than about 10%. Still others, such as prepaid interest and homeowners insurance, can vary because they depend on timing and choices the borrower makes. If the increases go beyond what is allowed, the lender must give the borrower a refund after closing. If the buyer is concerned, you can suggest they ask the lender to identify which fees changed, why, and whether any lender credit is due. A newer agent on your team is confused about why the buyer's CD shows your commission and various title and escrow fees. How would you explain the purpose of listing these charges on the CD from a consumer protection standpoint? Suggested answer. You could explain that the CD is designed to be a complete picture of the transaction from the borrower's perspective. It shows not just loan-related costs, but all major charges connected to the closing: commissions, title premiums, escrow fees, transfer taxes, and certain prorations. This transparency allows buyers to see where every dollar is going and to confirm that fees match what they agreed to in the contract and with their lender. It also helps regulators ensure that RESPA and TILA rules are being followed. As professionals, we should view this transparency as a positive because it builds trust and reduces the risk of misunderstandings or claims that someone hid a fee. Closing remarks. The TILA/RESPA Integrated Disclosure Rule is not just a set of technical requirements for lenders and settlement agents. It is part of a broader shift toward transparency in real estate and mortgage lending. For buyers, it means clearer forms, earlier information, and time to digest the numbers before signing a long-term obligation. For sellers, it means a more predictable process, even if it sometimes introduces short delays. For you as a real estate professional, it means that you must understand the timeline, the basic content of the loan estimate and closing disclosure, and how your contract terms, such as credits, prorations, and closing dates, interact with treaty requirements. When you combine this knowledge with your understanding of escrow, title, RESPA, and settlement charges from earlier sections, you are in a strong position to guide your clients from accepted offer to successful closing with fewer surprises and greater confidence.